Okay, today is Monday, December 23rd, 2024. It's Luther Wilson III here, real estate professional here in the Kansas City market, representing for Upside Property Services. As a lot of you know, on this channel, I talk about real estate sales, investments, and lending. All right, so tune in as I continue to put out content about what I do, opportunities that I see. The purpose here is to educate, inspire, and collaborate. All right, so for those people out there who are interested in real estate, interested in investments, interested in finance and lending, tune in, okay, and definitely check out some of my past videos as well. All right, so in today's session, I want to talk about private lending for real estate, okay? So loaning money to real estate investors is such a key part of the business for real estate investors, okay? And I had noticed over the years that it didn't really get talked about a whole lot. And so, you know, part of what I want to do here is illuminate some things and talk about how that works. Okay, so it'll help investors create more opportunities. And then also there may be some opportunities for capital investors or those that want to loan money to real estate investors as well. Okay, so again, I gotta talk about three big things in business. Okay, so it's not just real estate investing, but business in general. I see three main aspects. Okay, there's capital, there's strategy, and there's operations. All right, and some of you know my background as a real estate agent, property manager, project manager, working closely with contractors, investing, helping lots of investors get to it in one way or another. All right, and so with my background in property management and sales, working with investors, working with contractors, I was able to get a lot of experience on the operations side, okay, and as well the strategy side. So when I started to look at the capital piece, it really started to shift my mindset and how I operated. And I realized how important that piece was or is, definitely for me. And again, it depends on where you are in life and in business, your experience, your resources, your team, and all that to determine what aspects are gonna, you know, help you the most. Okay, so since I had a pretty good handle or experience with the strategy and operations, when I saw the capital piece, things really started to light up. Okay, so in the private loans, the private lending, the financing, at that point with my background, at that point it became critical. It was the most impactful thing for my business. Okay, and so, you know, when you're talking about loaning money in general to real estate or for real estate, you know, to real estate investors, all right, there's a number of things that you have to consider. And before we get into that, I want to go into some of the basics for a loan, a private loan that's backed by real estate, okay? So for financing, for a loan in general, there are two main documents that can be used, right? The first one is a promissory note, and the second one, depending on where the property is and the situation, the second one could be, the mortgage. It could be a mortgage, or in certain states, it's a deed of trust, okay? Those are the two main documents that you're gonna need if you're looking at borrowing or loaning money to a real estate investor, okay? So what is a promissory note? The promissory note is basically a promise to pay, and in it, it's gonna detail the terms and the usage, right? How long, you know, the money can be used, when it needs to be paid back, what interest rate is gonna be charged, and so forth, and then some other details in there as well. That's the promise to pay. The mortgage or the deed of trust is the note or the paper. That's the security. So if you're a capital investor and you want to loan money to a real estate investor or a contractor or an operator, those are the two forms that you're gonna need to look at and consider, all right? With the mortgage or the deed of trust, one key point with the mortgage for Kansas, all right, so we're here in Kansas City, so we do business in Kansas and Missouri, right? For Kansas, the form that we would use, or that we do use, is a mortgage, and it's a judicial state, okay? And then for Missouri, we use deed of trust, which would be non-judicial. So look that up, look those things up, okay? Don't just take my word for it. Ask around some of the people that you know who invest in real estate or loan money in real estate. Dig a little bit deeper because there's some implications there, all right? So those are the forms, the main forms that you're gonna wanna consider, all right? So the promissory note is gonna lay out how much is being loaned, what's being charged, is there interest rate, okay? Are the payments gonna be deferred, okay? So the borrower doesn't need to make the payment each month, and then how long they can borrow that money for, okay? So those are some of the basics, the documents and so forth, so you get a general idea of how that might look. Now, if you're in a position where you are looking to borrow money or you're looking to loan money for an investment, for a real estate piece of property, right? You got to determine, okay, based on how much is available to loan and how long you can leave that money tied up or invested, right? How long before you need that money back? Okay, so two big things there. How much money is available and how long can it be tied up for? Knowing those things, right? And then also, if you are using funds that may cost, right? So it's one thing if you're investing capital that you or someone you know has saved up over a period of time, but it's another thing if you or the capital investor is borrowing the money somehow that they then can lend to the investor, okay? So those are key things. That's a big deal, all right? So knowing how much is available, how long it could be tied up for, right? If it's gonna cost anything, right? Because there's gonna be a spread, hopefully, between how much you're paying to use that money and how much you're receiving in interest for loaning that money, okay? And then the time frame as well. So in Kansas City, right? If you've seen some of my stuff, pretty active on social media, our bread and butter, most of my clients, most of my colleagues, they're looking at B-class single family homes in and around Kansas City. That's where we've seen the absolute best success. We've seen a lot of success with C-class, definitely seen some with A-class, but as far as consistency over time, being able to do a reasonable amount of volume, B-class single family homes is where it's at, okay? So what's that look like? Okay, I could talk about what it was like or what it had been like over the last 5 years, but it's a little different now when you're talking how much you have available to invest or to loan or to place in some type of vehicle, right? So in and around Kansas City, B-class, some C-class single family homes, some A-class single family homes, that's where a lot of the action is taking place. That's where a lot of the money is being made. In C-class, that's where a lot of the money is being turned, for good or for bad, right? So in and around Kansas City, single family home, up through maybe, okay, part of 2023, part of this year. I know for me and my clients, our average entry to buy a fixer-upper, a house that needed repairs, it needed upgrades and or repairs, our average purchase price on that was around $100,000, okay? The average renovation, okay, excuse me, was approximately $50,000. That has since gone up, okay? So you may be looking at, if you're doing a significant amount of volume, what are those averages gonna be like? You could be 120 to 150 on the purchase, and now, okay, you average renovation could be $60,000 to $80,000. It is what it is. Things cost more now. The money costs more now. getting into an opportunity costs more now. So can you loan money if you have less than $50,000? Absolutely, all day long. You just have to be mindful, okay, of the opportunity, what that looks like, who's the borrower, what's their plan, and then how are you going to secure that? How are you going to secure that loan? Okay, because it may not work out. And if it doesn't work out, then you're looking at the default situation, judicial or non-judicial, or if you need to extend it out, or if you need to modify or adjust, okay, the original terms of the loan. I'm seeing it right now more than I'd seen in a very long time. Private money lenders, hard money lenders, investors who are taking on renovation projects on these fixer-uppers, that's where it's at, right? So it's taking a little bit longer to get these properties moved or sold. It's costing more and taking longer to get these renovations done, okay? And so there's some situations brewing, there's some stuff brewing right now, okay? So can you loan money if you have less than $50,000? Absolutely. But what's that look like? There's a very good chance, okay, so one other key part I forgot to mention earlier, when you're talking about securing the loan, okay, when you're loaning money and it's backed by real estate or it's secured, you got the property as collateral, right? You're either going to be in first lien position, meaning that there's no other loan on the properties besides yours. So the loan that you make to the real estate investor or property owner, if they have no existing debt, no existing mortgage, you then can secure it, okay, with the promissory note and the mortgage or the deed of trust. If there's no existing loan, you're going to be in first lien position, okay? If there is a mortgage in place already and you want to loan to the investor or property owner and you want it secured, meaning recorded, documented, on the public records, if there's already existing loan in place, then you're going to be in second lien position, which it can work out very well. Like we've done quite a bit with second lien position notes and loans and so forth, and we've been able to make it work, all right? So that's a big thing. If you talk to lenders out there right now, a lot of them do not want to do second lien position loans, which I don't blame them, because for a number of reasons, right? If you're talking about fix and flip or buy and renovate and refi, okay, you got a window. Are you going to, a lot of lenders, and you got to decide, are you going to do this too? You're going to give the investors 6 to 12 months to get in and through that project and have you paid back in full, along with whatever fees and whatever interest on top of that. Okay, so whoever is accepting that money, they're under the gun. There's some pressure there, whether we acknowledge it or not. And so there's a certain level of risk that is part of that, okay? So if you're gonna loan money to an investor and they already have the first lien position mortgage or debt, and they need some runway, which again, we're seeing this a lot more now than we've seen in years, where investors, because it took longer to get through the project and it costs more, and perhaps it's taking longer to sell the property, there's a number of reasons why investors are needing a little bit more capital or runway or additional gap funds or finish line funds, whatever you want to call it, okay? Name it whatever you want. Investors are needing more money to get through these projects, okay? So if you have 10, 20, 30 grand, up to maybe 50 grand, you have to understand that there's a very good chance you're gonna be in second lien position, perhaps even third position, okay? Unless you meet a property owner or an investor who has either owned the property for a long time, or maybe they paid cash for it, right? And you can loan 10, 20, 30 grand or 50 grand, maybe more, and they don't have any existing debt, okay, that's pretty safe. Okay, how often are you gonna be able to do that? Who knows? It depends on your operation and the opportunities in your market, how hard you push, how much you search, how many potential clients that you talk to about that. But if you can get into first lien position, great, right? But then you're talking second lien position. And the thing about investing in real estate, single family homes, fixer upper, renovation projects, that's it. That's a huge thing that we do as investors. And the reality of it is, even if the money is yours, so it's your money and maybe you got a partner involved and you have a short-term loan or you have a long-term loan that's in first lien position, there's gonna be gaps to fill along the way. Initially from the jump, if not initially, definitely along the way, and perhaps on the back end too, however that looks. So those gap funds, whether they're yours or a partner's, whether it's secured, whether it's documented or not, I still consider that second position, okay? So we gotta understand the process here. If I'm gonna take on a project to renovate a house and then resell it, I'm gonna need to borrow the money to get in and through that project. I may have a little bit of capital along with my partner, some capital, but because we're somewhat limited on how much we have at this point until we go raise more, however that looks, we're gonna need to leverage what we have somehow. So we're gonna get the first lien position loan in order to acquire the property and get through at least part of, if not all of the renovation. But there's a very good, no, you're gonna need gap funds, okay? And those gap funds, whether it's me or you, my partner, whoever your partner, right? Family member, friend, business associate, we're all doing it. It could even be a line of credit. It could be a credit card. You feel me? If you're not in first position, you're in second, however that looks. So those gap funds are key. Getting the down payment money, the closing costs, you got insurance, you got escrow for the insurance. It could be all tied up in there at closing. Okay, your lender may be generous on the front end and cover all of that. But even then, the gap funds over and above that is gonna be to help you get through the renovation project. Okay, so I talk about this stuff, gap funds, renovation projects, getting the operations, working with the contractors, communicating this, that's okay. My last video, I talk about this stuff. That's where a lot of investors fumble the bag, is with the renovation project and then also the property management, okay? So I wanna stay on track here and talk about the private lending, but I cannot talk about the private lending without talking about the strategy and the operations, okay? So when you're looking at loaning money to an investor, there's a good chance that you're gonna be in second position. Are you cool with that, right? Is the spread there? That's where you gotta look into the numbers. All right, what's the investor's plan? How much do they need? Are they gonna be refinancing once they're done with the project? Or are they gonna be reselling, okay? Because if they're reselling, it may take a little bit longer, but for a lot of investors, that's gonna be easier. Why? Because if they wanted to keep that property in order to refi, okay, the new lender is gonna look at appraising the property, the condition, and loaning up to 80%, 70 to 80% of the appraisal amount, okay? In a lot of cases, like the investor on the front end, their all-in amount could be more than that, okay? So how does that really look? So the point there is that it's gonna be easier for a lot of investors just to resell. So that's why there's entire outfits whose main thing, their main objective or strategy or play is to loan money to investors on a short-term basis so that they can get through the renovation and exit and resell, because a lot of times it's gonna be harder for them to refinance and keep, because in order to refi, the appraisal's gotta be on point, the borrower's credit, okay, the condition of the property, of course, and then there may be additional funds required, those additional gap funds to do the refi. So that's why I believe a lot of investors are doing fix and flip anyway. Okay, so you gotta determine how you wanna play the game. what's going to be your move, your play, your strategy for loaning money, because this is a big thing that's happening right now. And I did a post on social media. Check me out on LinkedIn, LW Realty 3. You can check me out on Instagram and Facebook as well. Luther3RE, Luther Wilson III. Look it up. I drop game every single week and I talk about this stuff. And I did a post a couple days ago and I said like, hey, like, do you like the idea of investing in real estate, but the thought of renovating, taking on a renovation project, or the thought of managing tenants or property management scare you? We know real estate, there's a lot of opportunities there. It can be very good, but the operations, okay? Hiring a contractor, hiring a property manager, you getting in there and doing labor on the renovation, or you're hiring a GC, however that looks. And then on the back end, if you're keeping these, are you gonna manage the rental? Come on, a lot of people, they don't need to be doing that. It's a lot, unless you bring in people, what I'm talking about. This is part of it. And I don't want to get too carried away, because the next video will probably be not just about the private lending, but collaborating, doing joint ventures with operators, with contractors, with investors who are on the ground. They can do all the heavy lifting for you, okay? So, said a lot there, but I think in general, look at private lending for real estate investors, no matter how much capital you have, but the more you have, the better, right? Because then you can be in first lien position, you could secure your capital there, okay? Everything's documented and recorded, and then depending on, you know, how much capital you have access to, your operation, your game plan, your business. If you're gonna go short term, that's one thing. But also you could look at doing long-term private loans for investors, which if you're gonna do, the reason that I, you know, am not bothered by second lien position loans and is because a lot of what we do is for the long term. Okay, so it's one thing if you're in second lien position and it's an interest only payment, okay, and there's a balloon at the tail end of it, then you're forcing your hand, you're forcing the investor's hand, because they have to pay you off in a short amount of time. If you're able to go long term, however that looks, and you can have your capital tied up for an extended period of time, with preferably without a balloon, and something that's fully amortized, you can structure it not only, you know, in first lien position if you have enough capital, or in second lien position, but you can also look at getting in there as part owner or getting equity on the back end long term for the equity long-term hold or cash flow play on that property. And think about the risk, okay? It may be a slower type of burn initially, but over time, at least from what we've seen, the long-term investments perform way better. They're if structured and handled a certain way, which, you know, again, I don't want to get too carried away. It's part of the reason why I push seller financing so much, okay? You start to see how this ties together. You can then enjoy more steady cash flow, larger back-end payouts, okay, less risk as part of your investment, okay, and then it's going to be a slower burn. You're talking 3 to 5 years. I'm looking at 10 years out for a lot of our investments, and I'm in the middle of those. My clients are in the middle of those right now, and that's where we have seen my, you know, clients who've been in the business for a while, my mentors, my advisors who've been in the game for 20, 30, 40 years. It's ridiculous. Like, that is without a doubt where they've seen the best results long term. So again, look at the private lending, do a little research. You could reach out to me, Upside Property Services, Luther Wilson. Again, we're here in the Kansas City market, doing the sales, doing the investments, doing the lending, helping investors get to it. So that's all I have for today. Appreciate you tuning in. Happy holidays. God bless. All right, take care. Peace.